This is an update post the Brexit vote in the UK, which we didn't pick. We expected that the UK would vote to remain within the EU, but it hasn't. Clearly, it's difficult to predict the outcome of a binary event like an in or an out vote, and so what we did with our portfolio was to try and immunise the portfolio from any result. Consequently, we invested in companies that we thought would benefit from a lower sterling exchange rate. The UK has been running quite serious twin deficits, fiscal and current account deficits, for a while. And it was pretty clear to us that sterling would come under pressure regardless of whatever the outcome of the vote. Consequently, we invested in companies that are known as multinational corporations that make a lot of their profits from operations overseas. GlaxoSmithKline, HSBC, and even National Grid, the UK utility company, which has a lot of investments in the USA, have all performed quite well. We're pleased about the way our portfolio held up, even though we didn't predict the result of the referendum. I think it's fair to say that people will now turn their attention to the next big political event, which is the US election. It's fair to say that Donald Trump, of the two, his victory, if it should occur, will be more unsettling for the markets. Hillary Clinton will be business as usual, and that will mean that we probably bumble along with lower interest rates than we'd like to see, as well as some attempt to boost the US economy, which has yet to really take off despite years of monetary stimulation. Based on the fact that we didn't predict Brexit, we're not going to bet the portfolio upon the way in which the US election is going to go. And what we've chosen to do is to try and identify cheap companies which will benefit regardless of who wins. We can currently identify 3 trends that we think are inevitable regardless of who holds the reins of power come November. The first of these is the US interest rate curve should normalise. We ought to see the long end of the yield curve start to rise as interest rates start to move up in the USA, and there should be what's called a positive yield curve, where short-term rates are lower than long-term rates. This will be good for banks. Banks' profitability depends upon a positive slope to the yield curve, and we've invested in banks which we think are cheap, and where we think Armageddon, financial Armageddon, is very unlikely to occur. They're well capitalized, they're well run, and we think the net interest margins will benefit from a normalization of the US yield curve. That's likely to happen regardless of who sits in the White House. The second thing we think is going to happen in the USA is a return to proper levels of investment in infrastructure. I went to the US in December and May of this year, and for the first time that I can recall, having lived there for many years, there was a sign that people are willing to admit that the US infrastructure, roads, airports, bridges, schools, all need significant amounts of capital investment. And we've positioned our portfolio to benefit from an expected increase in infrastructure investment. Currently, the US is running its fixed capital formation at about half the level it used to 30, 40, 50 years ago. We think that's going to return to normal, and there are plenty of ways to make money from investing in companies that build the necessary infrastructure. The third thing that we think is going to happen, regardless of the outcome of the presidential election, is that the US is going to be a home for technological innovation, both hardware and software. We think it's likely that the US will continue to lead the world, whether it's Apple or Microsoft, Intel, Cisco, or indeed smaller companies. So consequently, the portfolio that we have is also significantly invested in attractive technology companies, which we think will remain immune to any political deviations or vacillations as a result of the US election. We're currently fairly fully invested, and we've come through the wobbles in the market after the Brexit vote fairly well. We remain cautiously optimistic that we can make decent, high single-digit returns for our clients. Thank you for listening.